following presentation is intended for educational purposes only and does not replace independent professional judgment. Statements of fact and opinions expressed are those of the participants individually, and unless expressly stated to the contrary, are not the opinion or positions of Safe Federal Credit Union, its co-sponsors, or its committees. Safe Federal Credit Union does not endorse or approve, and assumes no responsibility for the content accuracy or completeness of the information presented. Attendees should note that the sessions are audio recorded and may be published in various media, including print, audio, and video formats without further notice.
Hey everybody, thanks so much for joining us tonight. My name is Katie Newman.
And my name is Virginia Mills, or Jenny Mills.
She goes by Jenny. We are your hosts tonight for Home for the Holidays. Our goal with this presentation is to talk a little bit about the mortgage world and just some of the things to kind of dabble in if you're looking to purchase, refinance, build. We've kind of got a little bit of everything tonight. So I'm hoping this will be very informational for everybody, a lot of fun, and of course, just kind of giving you some ideas about how you would like to move forward if you are interested in a mortgage loan in your near future. So let's get started. Of course, again, I'm Katie, and then my co-host is Jenny Mills. She's here with me today. We both cover the Sumter, Clarendon County, and Florence County areas. So we have,
County.
And well,
Lee County.
that's true. I'm sorry, Lee County as well. So let's go over some housekeeping rules. To start off with, this presentation is being recorded and should last about an hour. Time flies when you're having fun, so it's going to last us about an hour. Feel free to ask any questions in the chat. Everyone is muted currently, so you can only hear myself and Jenny talking, but you are able to type in the chat box if you have any direct questions, and we'll try to answer those throughout the presentation the best that we can. And then we also have some of our coworkers helping answer those questions in the chat also. So we want to make sure we get to everybody. And if it's not something we can answer currently, we can get back to it later on offline and make sure we answer everything that you're wanting to know. And then lastly, we are going to be sending out a copy of our slides to everyone that has provided us an email tonight. That way we can have connections in the future here.
And then, like she said, if you have any questions, you would submit them in the chat. But afterwards, we're going to be sending out a link in the chat for a survey for you to complete. If you complete the survey, we're going to have 2 respondents to the survey that are going to win a $25 Lowe's gift card. And who doesn't like Lowe's gift cards? Because you can get just about anything there.
Free money. That's what I'm talking about. So definitely make sure you hang around till we can send out that link. And let's get started. Oops, a little fast there. All right, guys, so we're going to start off with mortgage myths. So the first myth you hear about when you are looking to purchase a home is everybody needs 20% down. That is just absolutely beyond silly at this point in time. Nowadays, we have a little something called private mortgage insurance. Private mortgage insurance was invented to be a benefit to our members and a protection to the lender. It allows you to put less than 20% down, and just so happens we allow up to 100% financing. So you could put as little as 0 down with SAFE if you're looking to purchase. And that PMI coverage helps protect us as the lender financing such a larger amount on this house, but it is a huge benefit to our members because it is less money out of pocket for them in order to purchase their home. So that is debunked, and it's just not the way it is anymore. 20% down is just not required.
We need one of those Mythbusters things.
I know. I was just thinking, we need a bump.
A second myth that we have is that excellent credit is required. So that is absolutely not true. We have been able to approve people with lower credit scores. 620 is what we prefer, only because that would allow us to get underwriting automatically approved. But we have approved with less credit score. It just depends on how your credit looks. It's more about what's going on that's making your credit score low. And that's just something that we're going to look at on a case-to-case basis.
Absolutely. So another myth is just kind of leading back into that 20% down. PMI should be avoided. Absolutely no PMI. Guys, that is a terrible myth. PMI is a very huge benefit to our members. Just like I covered a second ago, we do finance up to 100%, which means no down payment. And that's less money out of pocket so that the opportunity is available to more members who are looking to buy their own home.
Next up, we are talking about our arms.
I have
And
two.
I know I have two. Well, yeah, I have two as well.
I hope you have
But in this case, we're talking about adjustable rate mortgages. Our adjustable rate mortgages are not dangerous. I believe that this myth came from when ARMs originally started. They had balloon payments of that had to come due at the end of the first terms. Like if it was a 5-year term, it would come due at 5 years. That is not the case anymore. At this time, our ARM mortgages are actually our lowest interest rate that we have. You pay interest and principal payment on the loan throughout the entirety of the loan, so there's no balloon payments available or due during the process of paying on the loan. So you just get a lower interest rate early on in the loan, and you always have the option to refinance later on in the process. So if you get to the point where you get past we call them a 5-1 ARM. If you get past the first 5 years and you decide that you don't want an adjustable rate mortgage anymore, you can always refinance to a fixed rate mortgage.
And these are ideal for like our first time home buyers.
And also military, they're going to be like, deployed, somewhere else, they don't know if they're going to be staying here long term. It's a really good option for them as well.
Absolutely. And first time home buyers on average stay in their very first home around that 5-year mark. I was the perfect example of that. I bought my first house. At year 5, we had outgrown it. We had 3 children. We were ready for something bigger. This is true. This is true. So moving on, lower rate is always better. So I find this so funny, just because I have what we call fence sitters here. It's the individuals who are kind of waiting for rates to drop. And if you kind of look back at the trend of how mortgage rates move up and down, there has never been a dramatic drop in rates. It's always slowly kind of trickled down, and we have maybe a small period of time where rates are very, very low, kind of like back right before COVID when they were really low, and then they kind of went back up to more average rates where they sit now. But SAFE offers a really fantastic product or benefit for our members, and it's called our simple modification. So it allows you to lower your rate once throughout the life of the loan for $500. And that's unheard of in some places. So
way cheaper than refinancing.
Absolutely. So we give you your current rate, what we quote you at the time of your application, and then later on once throughout that 30-year term, you get to decide when you want to lower your rate, when rates do go back down. This way you buy the house that you want, and you don't have to worry about later on bidding wars or having to pay more money for a house that you want just to get it because all the rates are low and everybody's shopping.
Yeah.
So yeah, lowest rates are not always the best, especially when you have that simple modification to fall back on.
The next one, or the final myth that we have on our board, I'm sure there's more, but the final one that we have is renting is cheaper than buying, which is absolutely not true. Mortgage payments are actually generally less than rent payments. Plus, you're paying towards something that you can use in your future if you need to. So if anything comes up and you need to use the equity in your loan for many different reasons. We're going to go over this a little bit later, but anything that you might need that equity for, you have that available. Whereas with renting, you would not have that available.
Exactly. Who wants to pay somebody else's mortgage if they can have their own house, right?
Why not?
Let's go for it.
Alrighty. So the next slide that we're going to look at is the mortgage process, the simplified mortgage process. So there's a few different steps that we go through, and generally this process takes roughly 30 days. That's our goal. So if everything goes right and we check all the check marks in the right order, we should be able to get you closed within 30 days. That being said, the first step that we have is the process of getting pre-qualified. This is where we get information from you, such as income, assets, and then we pull your credit. We then give you a letter with the amount that you are pre-qualified for, and you can go and look for a home. After that, after you start looking for a home, the next step is that you submit a ratified contract to us. This is where we after you find the home that you want, you make an offer, negotiate a price with the seller, and after you sign your purchase agreement, then you bring it back to us, and then the next step will get started. And that step is where you order your inspections. This is called a due diligence period. This is where you have the time to do an inspection on a house, which we highly recommend because you never know what problems are going on in the house. And the inspections give you the opportunity and the information that you need for the possibility of negotiation to cover whatever may be discovered. It may be foundation issues, there may be termites, all of these things are things that they will find, and appraisers will find, inspectors will find in the process of inspecting your home. These people are trained to find these problems, and they're also not being paid by, the seller or anything like that. So they're more likely to point out the problems. And therefore, you don't go into a home finding problems from the get-go that may become expensive in the long run.
Absolutely. So also during that time frame, once your contract is submitted, during that due diligence period, we have a 5-day time frame we want to collect your documents. So this is where we're going to verify your income. We're going to verify assets. We're going to ask for your homeowner's insurance quote. We're going to give you a list of documents that we need from you so that we can close your loan successfully. Once those are turned in within that 5-day period, generally your due diligence period is over with at that point, and the next step is to order your title and appraisal. The appraisal is going to give us an accurate value on the property to make sure that you're not spending more for that property than what it's valued at. You can also have negotiation possibilities depending on what that appraisal comes back at. And then title work, of course, checks the title history of that property to make sure that there's no unsatisfied liens or anything of that nature. After those reports have come in, we do provide a copy of that appraisal to you. So that you have it for your records, and then we send our file to underwriting for final review. After final review, then we go to closing, and you get your keys. And it seems like a really tedious process, but we are professionals at this, so we make it go really fast. Like Jenny said, we aim to close in 30 days or less, so it's a fairly simple process. A lot of this is behind the scenes stuff, and for the member, we try to make it as smooth and easy as possible.
We want to sweat. We don't want to make you sweat.
That's right. Just not too much.
Yeah, I don't want to stink.
I don't either.
The next slide is about the products that we offer. This is what everybody's interested in. They want to know what we can do for them. First of all, we have purchases. We have a wide variety of purchase offers that we can offer to our members, including first-time home buyers. We have 80/20 financing, which you can ask us a little bit more about that because it does get a little complicated. And in some cases, we actually have 100% financing available for our members. We have down payment assistance available, and once again, that's one thing that I would recommend you talk to either me or Katie about in regards to, so that you can find out what you need to do to get qualified, as well as how much funds would be available to you. Next, we have refinance options. These are the products that we have that allow for you to refinance your home to use it for equity for various different reasons. Home improvement, for example. We are going to talk a little bit more about that. We're going to talk a little bit more about that in another slide. We also will allow you to refinance your home to get a better rate. If the rates do drop, you do always have that option. Just remember that that option does cost, because closing costs. The closing process, it does cost some funds. So that's where the rate modification thing comes in, because it's way better than the cost of having to refinance a loan.
Absolutely.
But it's always an option if you need to. We offer up to 95% for financing for the loan to value of the home, which is unheard of. There are other financial institutions generally only go up to 80%. We go all the way up to 95%. Refinancing options such as our Freedom loans, they also have lower closing costs associated with them. I was just saying that closing costs are very expensive. With our Freedom product, it is much cheaper and generally faster as well to close. So if you're looking for a quick turnaround for a refinance, Freedom is the way to go.
Absolutely. I love a good Freedom loan. Before I move on to the next product, we actually have a question in the chat, and I'm excited to answer it. So Tobias asked, does a new home or mobile home have to be inspected? And that's a really fantastic question. So we do have an appraisal done, but the inspections are really up to the member. It is not something that we require. We do not require a home inspection to be done. We only require a CO 100 or an and an appraisal to be done. But generally with a new home, a CO 100 is not required. We require a soil treatment letter to show that the soil has been treated for any wood pests or anything of that nature that may cause harm to the home. But that is a fantastic question. But we only require CO 100 inspections, which are termite, and then of course the appraisal. But we recommend getting that home inspection.
Because that will protect you.
Exactly. And you don't necessarily have to do it on a new home. But for pre-existing homes, I definitely recommend it. I hope that answers your question. All right, moving on. So we do offer construction loans. These are one of my favorite products here at Safe because it's just a fantastic product. We only require 5% down. I mean, who does that? I had a member the other day come to me and say, you guys only require 5% down. Everywhere else I've gone requires at least 6. That's that land towards your down payment and your closing costs. So that helps less money out of pocket. That helps with keeping things going. Oh, do we have a mess up on the microphone there? Let's see here. All right, I'm gonna start over just a little bit because I think they just said that our microphone went out.
They said they can hear us now.
Yay, perfect. Thanks so
Con.
much. Sorry, guys.
Yeah, I think that's how you say it. I'm sorry if I am butchering your name.
Okay, so I'll go back to this. So we do offer construction loan products, and we only require 5% down on those construction loans.
Which is fantastic.
Construction loans with us, you can either already own your land, and if you do, you can use that down payment towards your closing costs and towards your down payment and your closing costs. Or if you don't own the land, we do offer the option to buy land and build at the same time. A lot of other lenders won't do that. They'll require you to have the land loan first, and then do the construction loan, which is 2 separate closings, 2 separate closing costs, and it's just a whole lot of blue that we don't make you go through.
And a headache.
Exactly. So we only do a one-time closing on our construction loans. Generally, once we get that contract, we can most likely get you closed in a 30 to 40 day time frame, and then after that closing, the builder starts to do the building of the home, and they make draws off of that loan as they progress through the build. And then you only have to make interest-only payments while the house is being built. You don't actually have to make your first mortgage payment until you get to move into the house and the home has been modified into that particular conventional loan. So only interest-only payments while the house is being built, and even better, it's only on the balance of the loan at the time.
Nice.
So if the builder doesn't make a draw for the first month or two and there's no balance, there's no interest you have to pay. Whoop, whoop.
Bonus.
So fantastic product we have for that. And we do have another question. So the land equity will be the down payment requirement. Yes, we do require that the land is included in the collateral. So we do use that equity in that land towards down payment. We do not do a separate loan against the house and then the land is owned separately. They are generally all tied together as one.
And we should also mention that that's also required for modular homes and manufactured homes as well, that we require that the land be tied into the loan. And I just want to mention that because there are a few people that have asked about that, and we do require that all to be tied together.
Absolutely, yes. And then with mobile homes, we do offer the option to purchase a brand new mobile home from a dealership with the construction percentage down payment of only 5%, but we do require that that mobile home be detitled after closing. And it's just how we
age requirement too.
Correct. But we have a fantastic product on that construction. So definitely come see us if you're looking to build. And then finally, let's talk about these home equities. That's what this main presentation was kind of about, was home for the holidays, and the holidays are coming up and we're going to eat a lot of food and we've got presents and all that fun stuff. So how can our home equity help us with that? SAFE offers a couple of varieties on home equity loans. So we offer a HELOC, which stands for Home Equity Line of Credit, and then we offer a HELoan, which stands for Home Equity Loan. The HELOC is a variable rate, and we're going to get into that in just a minute, kind of the differences between each of those. And then with the HELOC and the HELoans, they're treated very similarly to our Freedom refinance. They have very low closing costs. The closing time frame on these is fairly quickly, and if we can find a suitable value using our CRS data website or the county website for the value, we will not have to do an appraisal for that particular product. So that is our goal, to save you money is in every aspect of this loan as we can. And then of course, with the home equity loans, we also finance up to 95% of the value of your home.
Yay.
It's pretty awesome, I think.
Yeah.
All right, so let's dive a little bit deeper into the differences between a HELOC and a HE loan. A lot of people don't realize that SAFE offers HE loans. I have a lot of members that come in that request a HELOC, not realizing that we have HE loans. And it's really going to come down to the usage of what you need those funds for. So a HELOC is going to be very similar to what I like to say a credit card without the plastic. It is an open line of credit that is collateralized by some of the equity in your home. It is interest-only payments on the funds being used. It's a percentage of that balance is how that's calculated. It is a variable interest rate. It can fluctuate up or down depending on what your floor rate is and where the current rates are at the time. And it is a continual term, and payments can fluctuate as well depending on each draw and how much that draw is. A HE loan, on the other hand, is a more fixed, sturdy type loan. It gives you a lump sum at closing, whereas a HELOC, you don't necessarily have to draw anything off of that HELOC at closing. You can draw at any time. A HE loan gives you all the funds up front. It's interest paid on the full amount of the loan. So interest is broken up into your payments. You'll have a fixed monthly payment and a fixed interest rate on these HE loans. So a lot of times I have members that want to use these for more permanent one-time usages, whereas a HELOC could be used for multiple times, paid back and then used again. Some of the similarities between these two products are they both tend to be second lien position products. They fall generally behind the first lien position. We do have some members that want to have their HELOC as their first lien position because they've paid their home off free and clear, and they kind of want that HELOC to use as an emergency or as needed. Generally, if a member is looking to do a lump sum of money off of the equity of their home and they own it free and clear, I don't generally recommend a HE loan. I'll usually reach more towards the cash out refinance because of the difference in the rates and the term. But regardless, either way, we can finance up to 95% for both of these products. Which is amazing. Most institutions do not allow you to go over 80%. So we actually will go up to 95%. Again, for both of these products, appraisal may or may not be required depending on the value that we can find that's previously recorded. And then we only require a title opinion, which, like Jenny said, speeds up the closing process for these particular loans, and they don't take as long to close as the average normal conventional loan would be.
Right.
So let's get into some of the common uses for these particular type of loans. Jenny, take it away.
So there are many, many uses for the HELOCs and the HE loans, and some of them are, it depends on what product you want, what you want to do with the product, what product you're going to use in the process. So for home improvements, we can repair your roof, we can go and do remodel on the kitchen, you can remodel your whole house. You can, fix the shutters, and any of that stuff. If you want to, just do some cosmetic improvements, you can do that for your home. And you can use the equity in your home to be able to do all of this. It is also a good source to be able to pay off debts, especially high interest debts, like credit cards and personal loans that have high interest rates. Because this is a secure loan, it gets a lower interest rate for you than most of those credit cards and personal loans, even car loans. I've had car loans refinanced before. So, we have many different options that we can do as far for paying off debt, and it'll allow you to get that lower interest rate.
I love when you see the members that come to you that say, I want to do a home equity loan. I just want to pay everything off.
I know, right?
And then their debt to income super low. It just puts them in a better financial position, and they leave all around happy.
And then my little heart sitting there goes, oh man, I get to pay off debt. Yay.
It's someone else's, but we get to do it.
I know it's someone else's debt, but still.
But it puts them in a better financial position, and they go home happier.
And we make them, make their life easier. So, and that's one of the main reasons why I do this job, is to help make their lives easier. So. Another option that we can use for home equity loans is paying for education. Maybe your kid's in private school, maybe your kid's going to college and they got, they're moved into the dorm for the first time. They need some furniture, they need books. There's a lot of expenses when your kid moves into a dorm, let me tell you. So this can help fund those situations. Another option is that you want to go on vacation, which is fantastic. Let's be honest, the trips to Disney World are not cheap and they keep going up every single year.
Absolutely.
Home equity loans will allow you to go now and not have to save up the funds to be able to go. You can either go to Disney World, you can go on a cruise, but at least you can go ahead and go and enjoy the time now instead of waiting to save up, which could take years and years and years.
At least in my case.
Right? Because let me tell you, as soon as I get money, my kid knows it. So
They
something
smell
goes
it on
wrong.
you.
He hit a deer, you know.
Right.
The other option is funds for the holidays. And this is why we decided to do this mortgage seminar now, is so that people can get ready for the holidays. And, you know, maybe you're strapped for cash. Maybe this government shutdown is hitting you in the pocket and you need to be able to have a little bit of extra funds more than normal so that you can get a few presents under a tree. Maybe your kid wants that new PlayStation and those don't come cheap either. So if you need a little bit of extra cash for the holidays, this allows you to use your equity towards that to help pay for it. So yeah, these are all fantastic options that we can use the home equity in your home, the equity in your home for.
And these are just a few options. There's so many more
Oh, yeah.
options out there. I had a guy one time do a home equity loan to buy a boat. I mean, it just worked out better for him, and he actually got a better rate going that way than buying it with the boat loan. So
Sometimes it happens that
you
way.
just got to compare, and we're all about options and figuring out what works best for our members. So this is just a few little tidbits about how you can use that HELOC or that HE loan and to your financial benefit. All right, so let's switch gears a little bit. Let's talk about 3 elements to getting pre-qualified.
Okay. This is my favorite part because I love talking about credit. So when you're talking about, you know, getting pre-qualified for a home, one of the main things that people talk about is credit. And while we don't do what we call risk-based pricing, and we're going to talk about that a little bit later, but while we don't do that, we do still take your credit into account. And one of the things that the credit bureaus look at when we are trying to approve you for a loan is that they look for active trade lines. We need to have at least 3 active trade lines. Excuse me, I got a frog in my throat. So, for example, you want to have an auto loan, a credit card, and a personal loan. That would be 3 different trade lines. They can be, you know, 2 auto loans and a credit card. You know, we can mix and match. But, you know, that's generally what they're looking for is 3 active trade lines that have been active for more than 2 years, preferably. We can use non-traditional trade lines, like for instance, if you make your rent payment on time every month, if you make your utility payments on time every month, we can use that. The next step, if you're looking to get pre-qualified, is you want to make sure that you've cleared up any derogatory issues that are on your credit report. If you have any collections, you really want to work on paying them off. The sooner the better, because the longer that it goes from the time that you've paid it off till when your credit is pulled, the better it's going to reflect on your credit. You want to, you know, pay off the larger collections as well first, ideally. That's just like, you know, a little bit of advice from me to you. The third thing that you want to do is you want to make sure that you make your payments on time every time. That is the number one thing that credit bureaus look for to determine your credit score is have you made your payments on time? Even if you make the minimum payment, do that. So long as you satisfied the minimum payment, you're good. If you can make more, fantastic. You know, we're not going to turn you down, but it would absolutely be beneficial to you more so in the long run to make your payments on time every time. And if you need any information on your credit report, you can go to annualcreditreport.com to be able to pull your credit report up once a year and you can see what's on your credit report. And if you need any more information on other ways that you can clean up your credit, we have Sharita, who is available as our financial counselor. She is fantastic, and that's literally what she does here at SAFE. She's a financial counselor. She will help you work on your credit and make it into a better standing so that you can possibly get more financed. As in, we can go to a higher loan to value for you with a higher credit score.
Jay, let me pause you a quick second. We have a question, and I wanted to cover it real fast. So Tobias, he is on a roll tonight. Is it better for you to pay off credit, or should you still have some when you're trying to get a home?
Let me
go ahead.
Can I do that one?
Yes.
Okay. So you don't want to pay off all of your credit, only because credit works really weird in that you have to have credit to get credit. And it's really annoying, but that's how the credit bureaus work. So while it's fine for you to pay off, say, a credit card, don't close the credit card. So you could pay it down, but you definitely do not want to close it. And, I can get a little bit into this. I don't want to take up too much time about this, but the way that the credit scores work is that there are 5 different types of credit out there. You have credit cards, lines of credit, personal loans, vehicle loans, and mortgages. Generally, the people who get to an 800 credit score are able to touch on all 5 of those credit lines. After that, they're going to look at usage, and this is really in response to what you're talking about, Tobias. With usage, they are looking to make sure that you do not use more than 50% of whatever you have been approved of. So if you've been approved for a $1,000 credit card limit, for instance, you do not want to use more than 50% of that, which would be $500. Once you get to $500, you're going to start getting derogatory credit hits. So you want to stay below 500 or 50%. And ideally, they like for you to stay between 30 and 50. So trying to keep that in mind, it's actually more beneficial to you to pay down your credit than to close it off, because you will see a credit hit if you close out personal loans and things like that. Honestly, it would probably be better for you to put the money in an account just to make automatic payments on things like your vehicle or your personal loan, because then you would still have that credit line open, but it would allow you to keep that credit score positive.
That's a really good analogy of that.
Yeah.
Absolutely.
So yeah, that's just a few things that they look at. Like I said, I don't want to get too much in depth. And if you need to have any more questions about it, we can always refer you to Sharita. She's fantastic, and she can help you a little bit more with that. Okay. All right.
Let's talk about assets.
Assets. So most of our products do require at least 3% down. Obviously we have exceptions where we were talking about we can finance up to 100%, and that's fantastic. But, ideally we would like for you to have 3%, even 5% down, only because that would allow you to have a lower payment. But also if we can get 20% down, then you can avoid PMI. Not that it's a bad thing, as we discussed earlier.
But it's there for those who don't have it, right?
Exactly, because not everybody has 20 grand laying around. I get that. So it's a nice option for people who need to be able to utilize it. We need to be able to see these funds, though. You can't just promise me that you can get the money. I have to be able to see it, because when you're talking about something as legal as a deed, they need to be able to prove it, not just say it. So we need to be able to see the funds in your account. We need to know that you're going to have the closing costs and you're going to have the money for reserves. We can't go digging this stuff up out of the backyard and pulling it out of the mattress. Katie, I know that's where you have all your money.
Oh,
I mean, come on.
it's tradition.
Unfortunately, we can't use that kind of money. It does have to be deposited into the account, and we have to have it sourced. And that's how you source the mattress money, just so you know, Katie, for future reference. You put it in the account and you have to wait 60 days, and that makes it sourced. I think that's called, what's it called? Matured? No,
Matured.
what's it called?
Yes,
yeah, matured?
It's seasoned.
Seasoned, yes. Yeah, it's like salt and pepper.
Yeah. It's been sitting for a little while.
Yeah. So we have to know where these funds come from. So basically, if you sell a car and you have the funds deposited into your account, so long as you have a bill of sale and we can see that it was from a car sale or that you got an inheritance or something like that, so long as there's proof of where the funds come from, that's fine. But we just got to be able to see that. They got to see the paper trail.
So you mean if you're saving up $100 from your paycheck in cash every other week and you're putting it in your safe at home, we can't use that, right?
Unfortunately, no. It's got to be in the account. You can save in a savings account, and we have lovely savings options, available here at Safe. But no, unfortunately, it would have to be into the account for us to be able to verify it.
Gotcha. All right, well, let's talk about income and debt to income, which is shortened at DTI. So when we're doing a mortgage loan, the ideal debt to income percentage would be 45%. This is going to be all of the minimum payments calculated on your credit report, in addition to the new house payment that we're considering. All of that divided by your gross monthly income should not be any more than 45% of your gross income. We want to make sure that you are not going to be house poor. Okay. What good is a house if all of your money goes into it? You can't do anything else.
And you're stressed too,
Exactly. So we don't want our members to be in a financial bind. So the goal is to make sure that they are not over 45% debt to income when it comes to buying a new house or refinancing a house or building. A lot of times when we go to verify income, we're going to look for things like 2 years of employment. Now, there are exceptions to the rules. For example, I'll use a nurse, that's pretty common.
Mhm.
If you're a nurse that's been in your line of work for about 3 months, but you were in school previously, we can use that history to show that you are bettering your career to improve your income. But generally, 2 years is kind of what we look for. If you're self-employed or if you have rental income, excuse me, we'd like to look for 2 years on your tax returns. We just need some kind of history behind that to show that it's going to be steady and continue on as the time goes forward. We also look at 2 years of W-2s, so not only pay stubs, but W-2s as well, and just kind of get an idea of where your income sits and how it's going to proceed moving forward based off of the history that you have with your income.
And
Yeah?
we do adjust, obviously, because your income does adjust, hopefully, as you get higher and longer with the company. But we do take that into consideration.
Absolutely. And then part-time, of course, is a 2-year history as well. Full-time has some different leniencies depending on if you've moved jobs, if you've stayed in the same line. But ideally, this is kind of the rounded figures we kind of look for
Right.
as far as income goes. So let's switch things up a little bit. Let's talk about this versus that.
Pre-qualified versus pre-approved. Pre-qualified means that you have that we have requested your assets and income and verified your credit. Pre-approved means that we've verified all three. We've got tax returns, we've received your paycheck stubs, and we've pulled your credit. The difference is literally that pre-approval is just everything's verified. Now that pre-approval process can take a day or two, so if we get it to you immediately, you're probably pre-qualified. But we'll differentiate between the two for you.
But most sellers and real estate agents are okay with pre-qualified.
And most of them require it now for you even be able to go look at a home. They want you to be pre-qualified at the very least so that they can know how much you are able to spend.
Absolutely. So let's talk about FHA versus conventional. I get this question a lot. What's the difference? Why don't we do FHA? Why do we only do conventional? What is conventional? Well, FHA is a government insured loan. They do require 3.5% down. They have a little bit more restrictions on their appraisals, but their credit approvalness can be a little bit less limited. PMI is required for the life of that loan when you're doing an FHA loan. And like I said, they do require at least 3.5% down. They don't offer 100% financing option, but they do have credit score restrictions that are a little bit lower. So they have their benefits, but they do also have their cons as well.
Right.
Conventional loans, which is what we do here at SAFE, just means that there's no government insurance behind these particular loans. It just means that the lender takes full responsibility for this loan. And then, of course, we have PMI on the top half of the loan if you put less than 20% down. PMI on a conventional loan actually will fall off after 78, once you hit 78% of the value, whereas FHA stays for the life of the loan. It never falls off unless you refinance out of it. And then conventional has a little bit less restrictions on appraisals. They're a little bit more forgiving when it comes to the appraisals. You don't have to have handrails on the stairs, and peeling paint's not really a big deal, versus FHA would require those to be fixed. So there could be more out-of-pocket expenses for an FHA depending on what issues need to be fixed with those appraisals. And then, of course, conventional, we can do up to 100% financing. Who doesn't love a no down payment option?
Seriously. All right, now we're going to get into more with the rent versus own that I was talking about earlier. Why is it beneficial for you to own your home as opposed to rent it? Well, right now, the current average rate for rent in South Carolina is $1,379. So if you're paying less than that, you better be, cheering for joy.
Woo!
But honestly, most people pay more. So when you're paying rent, you're paying for someone else's house. You're paying for their equity. You're investing in them. Why not invest in yourself? Principal and interest payment on a $200,000 house is only $1,199. And I know I just said that only, but it's still a lot less than the average payment for rent in South Carolina. And in this situation, when you own your own home, you're paying for your own home. You are giving yourself the option to use equity later on if the need arises. And therefore, and also, here's the great thing about it. When interest rates go down, you can always refinance and get a lower interest rate. You can get a lower payment. Does your rent ever go down?
Absolutely not.
It only goes up. So while when you own a house, it can fluctuate your payments based off the interest rate at the time. Your rent is never going to fluctuate if any, well, it is going to fluctuate. It's going to fluctuate up. That's the way I look at it. So it makes it so that you can be able to save this money a little bit in the equity. And should you decide to sell your house and move on, you can take that equity with you to purchase your next house. Whereas if you're renting, you don't take anything with you. You literally go with what you came with. You might be able to get a security deposit back if you don't have cats that tear up your wall, you know? So, it would just be more beneficial for you in the long run so that you could take that equity with you and be able to utilize it. Because if you're going to pay for it, why not use it?
Exactly. Why not have something to show for it?
Stupid cats.
Right? Well, I'd only have one. So let's talk about fixed rate versus the ARM. We talked about the ARM earlier. Jenny gave us a good description of what an ARM product is. Here at SAFE, we offer a 5-1 ARM. It's fixed for the first 5 years, and then it can adjust up or down from year 6 to year 30, just depending on where the market is currently at that time. There are benefits and cons to both of these particular type of loans. So with our fixed rate mortgages, they're good for long-term purchases. If you're going to stay in the home and this is your forever home, fixed rate is the way to go. And then as far as the rate goes, we talked about that simple modification that allows you to lower the rate once throughout the life of the loan. So those are going to be more ideal for your fixed rate loans. But the ARM is going to fall into place when you have it more of a short-term time frame. So like we talked about earlier, first-time home buyers who on average stay in their first home anywhere between 3 to 5 years and then want to look for something bigger or upgrade possibly later on, an ARM product would be fantastic for them because they would actually end up needing to refinance that loan or sell the house within the first 5 years. And they get to take advantage of that lower rate for the first 5 years and then move on to their next property at that time. Military is another good option for someone who may be stationed for 3 or 5 years in one area and then are eventually going to need to move again. These ARMs are a fantastic option. Another thing I ran into the other day, Jenny, let me tell you about this. You may or may not know of this, but I have members that are that currently own their home. They want to sell their home, buy a new home, and then use the proceeds from the sale of their current home to pay off the new house. Well, they went with the ARM rate because it was a low rate for the little bit of time that they were going to be living or be having the loan on that house until their current home sold. So there's a lot of different good advantages to these ARM products compared to fixed, just depending on your situation. It's not ideal for everybody, but both of these options are fantastic and they would fit anybody's scenario that may necessarily need them.
And one thing I do want to mention about the ARM is that interest is capped. Even though it does fluctuate with the market, there is a cap on it too. So don't think that you're just going to go sky high through the roof. There's a certain amount, I think it's 5%, that you can only go up to above what you started with. So there is a limit to how high it can go.
And that's lifetime.
Yeah.
2% is only for the year, and that's if it even goes that
If
high.
it goes up, because right now they're on the downswing and we hope it stays on the downswing, you know. That would be ideal because I want to get back down to 3%. That'd be fantastic.
Oh yeah, I think everybody would like that.
Yeah.
But yeah, it's fantastic options here that we have. So why are we going with SAFE? What's the point of any of this? What makes SAFE so great?
Well, our first one, the most important one, is that we offer a 120-day rate guarantee.
Unheard of.
Exactly. Nobody else does this. When we run your credit at the beginning of the process, we will lock in that loan rate for you for the next 120 days. So that gives you 90 days just to look for a house. And assuming we can close in 30 days, which once again, that's the goal, you will have that credit rate, that interest rate locked in for that entirety. Now, when we go and actually do the second credit pull, because we do 2 credit pulls, we pull a credit again right before closing. When we pull that credit, if the rate has gone down, you're still going to get that lower interest rate. But your rate won't go up if the rates have gone down. If the rates have gone up, I'm sorry.
So you have the opportunity to get the lower rate if rates drop during processing.
Exactly.
I love it.
Yeah.
Then, of course, I have said this multiple times, we have that fantastic simple modification that allows you to lower your rate once throughout the life of the loan. This is offered on all of our fixed rate mortgages, even construction loans. This is one of our big key selling points with some of the builders that I work with. They love the fact that the members can build now, not have to worry about really what the rate is at the moment, and know that they have the option to lower it and they're not stuck with this rate for the next 30 years.
We also offer year-end bonus dividend payouts. That is a payout that we offer as a credit union to all of our members here at SAFE, but the people who benefit the most from it are the people with larger loan balances, aka mortgage people, mortgage loan members. So if you have a mortgage loan with us, generally it means that you're going to get a higher payout because we base it off of how many funds you've borrowed from SAFE. Now, this is also subject to board approval, just so you know. But yes, it is a nice little bonus that we offer at the end of the year to help recover from Christmas, because we've all spent way more than we should have. Or is that just me?
Nope, me too. Me too. Always, always. I tell myself I'm going in with a certain amount, and then bam, it blows it out of the water.
Black Friday kills me every year.
Oh yeah, for sure. So another fantastic thing that we offer here is we service all of our mortgages here at SAFE. You don't have to worry about having to figure out who you're going to pay your mortgage payment to each month from it being sold from lender to lender. All of our mortgages stay right here with SAFE. We service all of them, so there's no fear of having to know who your next mortgage person is going to be that you need to pay, because that can be a real headache, I'm sure.
Well, yeah, because you never know, who for instance, banks like to do that. They like to sell their mortgages to outside companies, and you started with Wells Fargo, for instance, just as an example off the top of my head, and then all of a sudden you're over here and you're like, who the heck is this?
Right. Who do I pay this month?
I don't even know where this bank is. So the other option, one of the other benefits that we offer our member is a $500 credit for our first-time home buyers. That's going to be $500 off of your origination fee, which will make a difference in the money that you have to bring to closing. So that's a fantastic benefit that we offer to our first-time home buyers.
We also do no risk-based pricing. This means that we do not base your rate off of your credit score. So anywhere between 620 all the way up to 850. Can you go that really? I think we can go that high, right? 850.
I haven't.
is going to get a good interest rate. So we don't base off of their rate. We don't give you a pretty little rate in the very beginning, and then when we pull credit, your rate makes it go shooting through the roof. We don't do any of that. We are upfront, clean, easy to go, and we want to make sure we are offering the best rates to everybody that comes across our front doors.
Exactly. We also offer local processing and underwriting. That means that all of our processors and underwriters are actually located at our Westmark Boulevard location. We're all here in town, and you don't have to wait for emails to go through to find out what's going on with the processing and the underwriting. I can literally walk across the
room.
The room. I was trying to think of what you call it between the cubicles. What do you call that? The path? I don't know.
Yeah.
So I can walk across to talk to our processors or our underwriters. So that's a great benefit for us and
Absolutely.
for our members.
It keeps our team close, and it keeps us working the best for our members.
Exactly.
And fantastically, we offer pre-approved credit cards. All of our members who close get pre-approved for a credit card with SAFE if they don't already have one. When you're buying that new house, what's the first thing you want to go out and get?
Cleaners.
No.
That's what I want to get.
No. What's the first thing you want to get?
I don't know.
Furniture.
Well, yeah.
You want to go buy that furniture, and you want to put appliances in your house and decorate and all the fun stuff.
I'm
and
cleaning.
Sometimes you need that credit card. Well, you go buy your cleaners. I'm going to go buy decorations. But we offer this to our members. We have a fantastic credit card program. With our credit cards here, they are a variable rate, but they are nowhere near as high as Lowe's and
Absolutely.
Capital One and all of the others. So definitely a huge benefit to our members. It's not another credit pull. You simply call in with the letter we send you, and the credit card is instantly issued to you. So
we also have a cap on it too. Like our interest rates are capped, whereas the Lowe's and all these other ones that she mentioned, they aren't capped. So that's one of the benefits that we offer here at SAFE as well.
Yes. So I mean, just oodles and oodles of benefits for our members.
Don't forget, we appreciate y'all showing up today, but don't forget to fill out the survey for your chance to win the Lowe's gift cards. We're going to be putting the survey link here in the chat in a moment. So don't forget to respond so that you have the chance to win the two $25 Lowe's gift cards so you can go out and get you some more cleaners.
Exactly, right? So guys, that is it for our presentation. I hope we learned and taught you a whole lot more. And please don't hesitate to reach out to Jenny or myself if you have any further questions or need more scenario specific details. We are here to help you and help you live your financial best. Keep an eye on the chat here in a few minutes. Our lovely Jenna Howell. Whew, Jenna Howell is going to put that link in there for you to fill out your survey. And that way we can do a drawing here over the next few days. We love you guys so much. Thanks for joining us tonight and have a fantastic, safe evening.
Have a safe evening.
Bye-bye.
Bye.